All right, so today we're going to do something a little different. We're not just going to look at the headlines. We're going to dig deep into the official data to find out what's really going on with the U.S. job market. So, let's get into it. And really, this is the million-dollar question, isn't it? Is the U.S. job market a lot weaker than it looks on the surface? The official numbers have been telling us one story, but if you look a little closer, yeah, something else might be happening entirely. Okay, to get why this is such a shocker, you gotta rewind the clock just a few months. Back then, pretty much everyone agreed the U.S. economy had pulled off something amazing.
I mean, look at this quote from Goldman Sachs. It perfectly captures the mood. It really did look like a perfect soft landing. The Fed, they jacked up interest rates to fight inflation, but they did it without crashing the economy. The job market had just gently rebalanced. It seemed like the best-case scenario, for real.
But then, bam, the July jobs report came out. And it wasn't just the new number. It was the revisions they made to the old numbers. Suddenly, that perfect picture, it had a huge crack right down the middle. Okay, so to really see why this is a big deal, we need to talk about a key idea. It's called break-even payroll growth. Just think of it like this. It's the absolute minimum number of jobs the economy has to create every month just to tread water, to keep the unemployment rate from going up as new people look for work. So what's that magic number today? Well, because immigration has slowed down a bit, experts figure we need to add about 80,000 jobs a month. That's our target. That's the bar we have to clear to say things are healthy. And here's the bombshell. After all those downward revisions we just talked about, the actual trend for job growth has just collapsed. We're now only adding about 30,000 jobs a month. So let's be clear, we're not just missing the target, we're falling way, way short. So that's the big mystery, right? Is this just a little blip, a statistical fluke that's going to fix itself next month? Or is this the first real warning sign that the economy's foundation is actually starting to crack? Well, to figure that out, economists are basically putting on their detective hats. They're digging deep into the nitty-gritty of the official data, looking for clues. And what they're finding, well, it suggests the numbers we've been getting have been a little too rosy for a while now. In fact, they've zeroed in on 5 key reasons to be a bit skeptical. We're going to look at everything from a wonky statistical model called the birth-death model to some quirks in how they adjust for seasons, and even a really weird situation happening in healthcare data. Let's walk through each clue, one by one. All right, clue number 1. It's this thing called the birth-death model. It's basically a statistical guess. It tries to estimate how many jobs are being created by brand new businesses and how many are lost when businesses shut down. The problem? It looks like it's being way too optimistic right now, probably adding about 10,000 phantom jobs to the total every single month. Okay, clue number 2 has to do with something called seasonal adjustments. See, the computers and algorithms that try to smooth out the data can get confused. They might see a real slowdown starting, but mistake it for, say, a typical summer hiring dip. And then, months down the road, they have to go back and issue these big negative revisions to fix it. And clue number 3? It's just simple history. If you look back, whenever the economy starts to slow down, the first job reports that come out almost always turn out to be too high. It's a pattern. The numbers we're seeing today have a really strong tendency to get revised lower later on. Okay, now this next clue, this one is fascinating. It's what's being called the healthcare anomaly. Get this, over the last 3 months, healthcare hasn't just been the main driver of job growth, it's been the only one. It's actually responsible for more than 100% of all new jobs. And if you're thinking, wait, how is that possible? It means that the rest of the economy, all other sectors combined, are actually losing jobs. And this chart right here just shows you how crazy the situation is. On one side, you've got the official government data, the BLS, showing this massive boom in healthcare jobs. But then you look at private payroll data from a company called ADP, they process payroll for tons of companies, and their numbers show over 100,000 fewer jobs being added each month. That is a gigantic gap. It really makes you question which number is closer to reality. So our final clue comes from a completely different government survey called the Household Survey.
And it looks like this survey is using some really outdated numbers for immigration, numbers that are probably way too high. This little error could be pumping up the job growth figures by as much as 50,000 jobs every single month. So you start to add all 5 of these clues together, and the picture starts to look very, very different.
Okay, so we've done all this data detective work, but what does it actually mean for hiring in the real world? Well, these aren't just numbers on a spreadsheet. They're pointing to a hiring engine that is seriously starting to stall out.
You know, for the last year or so, pretty much all of the job growth we've celebrated has come from only 3 places: healthcare, education, and government. And these are all sectors that got hammered during the pandemic and were basically just playing catch-up to get back to normal staffing levels.
And this chart just lays it bare. Look at the bar for those catch-up sectors. Still growing, right? But now look at the bar for every other sector in the U.S. economy combined. It's flat. It's basically at 0. Outside of those 3 areas, hiring has pretty much stopped.
So after all that, what's the verdict? What does this all mean for the economy? And more importantly, what's the take from the one group whose opinion matters most, the Federal Reserve?
Well, the conclusion seems almost unavoidable. You've got weak underlying job growth combined with a really high chance of even more downward revisions coming. All of that has likely put the Fed on high alert. The evidence is mounting that they're getting ready to change course and start cutting interest rates again.
And it's not just a vague idea. Here's a specific forecast from Goldman Sachs. They're expecting a whole series of cuts, one in September, another in October, one in December, and then 2 more cuts next year. This would be a huge shift in policy, and it's all being driven by the weakness we've just been digging into.
And so all of this leaves us with one last really big question. We know the Fed seems ready to act, but are they cutting rates to keep a good recovery going, or are they cutting rates to try and stop a recession before it starts? The story behind these numbers, well, it strongly suggests it might be the latter.